Welcome to this new episode dedicated to finance and investing. Today we are discussing one of the most important topics of recent years for anyone who invests and for anyone who wants to understand where the global economy is heading. We are talking about the artificial intelligence revolution and the risk or the opportunity of a new technology bubble. In recent months, financial markets have shown extraordinary movements. Some companies connected to artificial intelligence have experienced impressive growth. Their valuations have risen rapidly, attracting capital from all over the world. Institutional investors, funds, and retail investors all seem eager to participate in this new gold rush. But we need to pause for a moment and ask a fundamental question. Are we witnessing a real and structural economic transformation, or are we entering a phase of collective euphoria that could turn into a speculative bubble? To answer this question, we first need to understand the context we are operating in. Over the past few years, we have gone through a global pandemic. Central banks injected massive amounts of liquidity into the system. Interest rates were kept extremely low for a long time. Later, as inflation increased, those same central banks reversed course and raised rates aggressively. This created a complex environment. On one side, slower growth and a higher cost of capital. On the other side, a strong need for innovation and productivity improvements. This is where artificial intelligence enters the picture. AI is not a technology that was invented yesterday. It has existed for decades. What has changed recently is the combination of computing power, the amount of available data, and the improvement of algorithms. This combination has made artificial intelligence scalable and commercially viable. Companies have realized that AI can reduce costs, automate processes, improve strategic decision-making, and create entirely new business models. In other words, it can increase productivity. And when we talk about productivity, we are directly talking about future profits. Financial markets do not focus on the present. They focus on the future. If the market believes that a technology will increase profits over the next 10 or 20 years, it is willing to pay a high price today. The problem begins when expectations become too ambitious. If we look at history, we have seen something similar before. In the late 1990s, the internet was a real revolution. It was not a fantasy. It was a structural transformation of the economy. But the market started pricing any company with the word internet in its name as if it were destined to dominate the world. Many of those companies had no profits, and some did not even have meaningful revenue. When expectations adjusted, the market collapsed. The Nasdaq lost nearly 80% of its value within a few years. The lesson is not that the internet was a scam. The lesson is that a revolutionary technology can coexist with a financial bubble. Today, we must ask whether artificial intelligence is following a similar path. There are leading companies investing tens of billions of dollars in infrastructure, data centers, and advanced model development. Some of these companies are generating substantial profits. This is an important difference compared to many firms during the dot-com era. Today, we are talking about corporations with real cash flows. However, their valuations already incorporate very high growth expectations for many years ahead. This is where a fundamental financial concept comes into play, the present value of future cash flows. When interest rates are low, future cash flows are worth more. When rates rise, the present value of those cash flows decreases. In an environment where rates are higher than in the previous decade, the market becomes more sensitive to disappointments. If a major AI company fails to meet growth expectations, the reaction can be severe. Because the price already reflects an optimistic scenario, this does not mean AI is destined to crash. It means volatility could increase. From a macroeconomic perspective, artificial intelligence could represent a new growth cycle. If global productivity increases, companies can produce more with fewer resources. This translates into higher margins and potentially sustained economic expansion, but the transformation will not be linear. There will be overinvestment. Some companies will fail. There will be consolidation and restructuring. This has always been the case during major technological revolutions. For an investor, the question is not simply whether this technology will succeed. The correct question is, at what price am I buying this growth? If you overpay, even a great company can become a poor investment. If you pay a reasonable price, even moderate growth can generate strong long-term returns. This brings us to strategy. A disciplined investor does not chase euphoria. They do not buy simply because a stock is rising. They are not guided by social media hype or sensational headlines. Discipline matters more than intuition. Diversification remains fundamental. Even if you strongly believe in artificial intelligence, concentrating all your capital in a single sector increases risk. Markets can remain irrational longer than you can remain patient. Another common mistake is confusing innovation with profitability. A technology can be extraordinary but still require years before generating stable profits. In the meantime, valuations can fluctuate significantly. We must also consider the emotional factor. Markets are driven by two primary forces: fear and greed. During euphoric phases, greed dominates. During corrections, fear takes over. The investor who maintains clarity during extremes is the one who tends to achieve the best long-term results. Let us imagine three possible scenarios for the coming years. In the first scenario, artificial intelligence delivers on its promise. Productivity rises, companies grow earnings, and current valuations prove justified. In the second scenario, we experience a significant correction. Perhaps 30 or 40% declines in the most overvalued stocks. After this cooling phase, the sector continues to grow structurally over the long term. In the third scenario, a macroeconomic shock occurs: a global recession, reduced investment spending, and a sharp reset in expectations. Which scenario is most likely? Probably something in between. Structural growth over the long term, combined with substantial volatility in the short and medium term. The conclusion is simple, even if it is not always easy to accept. Artificial intelligence represents a real transformation. But the price you pay determines the return you earn. Investing does not mean predicting the future with certainty. It means managing risk rationally. You do not need to identify the next stock that will double. You need to build a coherent, sustainable strategy aligned with your time horizon. If you have a long-term horizon, patience is your competitive advantage. If your horizon is short, you must accept greater exposure to volatility. Always remember this fundamental principle. In financial markets, the winner is not the one who is right about the technology. The winner is the one who is right about valuation and risk management. Artificial intelligence could be the greatest investment opportunity of our generation, but only for those who approach it with discipline, awareness, and a long-term perspective. I will see you in the next episode.